Pepsi reported earnings today and beat analyst expectations on both revenue and earnings. The stock is now up about 4% on the day, and it's one of those businesses that everyone knows about and has consistently been growing for decades. Over the past 20 years, Pepsi has returned over 230% and slightly outperformed the S&P 500, while also being a much less volatile stock. However, when we include dividends, the stock has returned over 325% and has outperformed the SPY even more. The dividend has also been consistently growing over the decades with the overall growth of the business. In fact, if you purchased Pepsi in 2002, you would now have a dividend yield on cost of nearly 12%, which means that you would be getting a 12% return in cash on your original investment every single year. In today's video, I want to go over Pepsi's earnings and the Pepsi stock and discuss whether the stock is a buy now or if investors should be avoiding it. I think the conclusion I come to isn't what you're going to expect either, so with that being said, let's just dive right into it. Alright, so I went and I took a look through Pepsi's most recent financial reporting that they just announced today, and I found some of the key things that investors should know and why I believe the stock is up about 4% on the day now. So right here, right away, we can see that Pepsi had a net revenue growth of 8.8% in the third quarter year over year, and the revenue is up 7.7% year to date. So the business's revenue and its top line is still expanding, and it's actually growing quite nicely and consistently. We can also see that the EPS for the third quarter is up 22% year over year, and year to date, the earnings per share is up 33%. So on the surface, it looks like Pepsi is keeping its profits intact and actually getting more profitable as inflation is soaring. Now, in this next screenshot right here, this comes from Pepsi's CEO, and this is kind of just their comments. And I have an underlined section right here that says, "We now expect our full year organic revenue to increase 12%, previously 10%, and core constant currency earnings per share to increase 10%, previously 8%. So the CEO is also increasing the company's guidance. In my opinion, this wasn't really expected because companies right now are actually lowering their guidance. Pepsi coming out and beating analyst expectations and also raising their guidance, I think took the market by surprise, and that is why the market is rewarding the stock so much today. Now, in this next screenshot, this is for their Frito-Lay's North America division, but this is basically across the entire business. So this is just one segment of the business, but the thing that we're going to talk about here does apply to all areas of the business essentially. And this says, net revenue grew 20%, primarily driven by effective net pricing. The business is essentially saying that they're increasing their revenue from price increases. And take a look at the next underscored line here. This says unit volume declined 2%. So the unit volume, the amount of product they're actually selling, declined by 2%, but revenue grew by 20%. How that happens, again, is because Pepsi is increasing its prices on its products. So even though they're shipping less products, because the prices are higher, they're making more revenue. And this is why Warren Buffett has said that the best investment to own, or one of the best investments to own during high inflationary times, is a strong brand. And Pepsi has one of the strongest brands I've ever seen with their Lay's, with their Pepsi brand. So with inflation, Pepsi is able to increase their prices and ultimately increase their revenue with inflation, even though they're shipping and selling less product. Then it also says operating profit increased 17%, primarily reflecting the effective net pricing. So their operating profit on Frito and Lay's did also increase. Now, what's interesting though is I went over and I took a look at Pepsi's cash flow statement because I always take a look at the cash flow statement, okay? I don't just take a look at the income statement because I think that EPS and everything can be manipulated. And I like to take a look and see if the cash flow is backing up the earnings. And what's interesting right here is if we take a look at the operating cash flow or the net cash provided by operating activities, the operating cash flow this year for Pepsi is actually down about 5%. So the amount of cash that the operations are producing is down. Even though EPS is up, operations are down. Now, the main thing that I found here is that there was a gain associated with the juice transaction, which was about 3.3 billion that accounted towards earnings per share, but did not account to operating cash flow. This number right here was essentially in the earnings per share figure, but not in the operating cash flow figure. And I think that this is causing the EPS to be much higher while the operating cash flow is not as high. Now, what's also interesting is right here, the capital spending. This is essentially Pepsi's CapEx, which is subtracted from operating cash flow to find free cash flow. We can see that the CapEx is also up about 5 to 10% year over year. And when you take the operating cash flow and you subtract it and you subtract the capex, we get about $3.75 billion in free cash flow so far year to date for the company. So remember that number right here, $3.75 billion so far on the year in free cash flow. Because when we go and take a look at Pepsi's cash dividends paid, we can see that they have been about 4.6 billion. Now, what this means is that the company is currently spending more on paying dividends than they actually generate in free cash flow. On top of this, they also do share buybacks and share repurchasing, and they've done about $1.2 billion worth of share repurchasing so far this year. Together, this is about $5.74 billion spent on dividends and share buybacks. And remember, the company has only generated $3.75 billion in free cash flow this year. Basically, what I'm trying to say here is Pepsi is paying out more in dividends and buybacks than they actually make organically, which I don't love to see, honestly. And if we actually head over here to Stock Unlock's freeform tool, we can go and take a look at Pepsi, and I can better represent this. So what we're going to do is take a look at Pepsi's net dividends paid versus the company's free cash flow over time, over the past 20 years. And we can see here that historically, Pepsi's free cash flow has been higher than the dividends paid. However, right here in 2020, in the first quarter, this was the first time over the past 20 years where Pepsi paid out more in dividends than they produced in free cash flow. Now, once Stock Unlock updates this, once we actually get the third quarter numbers in the platform, which takes a few days, the numbers should come back down once again. Now, what's also interesting is if we scroll down, we can see that Pepsi has been growing its dividends paid at 9% annually, but the free cash flow has only been growing at 3% annually over the past 20 years. So Pepsi has been growing its dividend per share at a faster rate and growing the amount of money that it pays out in dividends at a faster rate than the company's free cash flow. What this ultimately means is the dividend per share is not going to be able to continue growing at this rapid of a rate, at this 9% rate, if the company's free cash flow does not company's free cash flow does not accelerate in the future. Eventually, there's going to be a limit where the dividend can only grow so much and it meets the company's free cash flow. And it actually looks like we're getting to that point right around now. Also interesting is if we take out the dividends paid and we go to the net amount returned to shareholders, which is the dividends plus the share buybacks, we can see that there has been multiple periods throughout history where the net amount returned to shareholders has exceeded the company's free cash flow. And then when this happens, it means that the company is spending more money on, returning cash to shareholders than it can generate organically. Right here in 2015 was an example. Right here in 2019 was another example, right here in 2010, and right here in 2008. So it does look like the company does have a history of returning more cash to shareholders than it can actually generate organically, which is something to definitely pay attention to. So now let's take a look at Pepsi's free cash flow growth just over the past decade. And we can see that Pepsi has grown its free cash flow at a compounded annual growth rate of only 3%. Now, what's interesting is if we take a look at Pepsi's stock price over the past decade, it has grown at a compounded annual growth rate of 9.37%. And we can clearly see that the stock price is growing much more rapidly than the company's free cash flow. So essentially, the price of this business is growing faster than its fundamentals. And what this ultimately leads to is if we take a look at the price to free cash flow, it has been growing at a compounded annual growth rate of nearly 7% a year over the past decade. So where a lot of Pepsi's stock price returns have come from over the past 10 years isn't from the underlying fundamental growth of the business. Again, we saw free cash flow has only been growing at 3% a year over the past decade. Where the stock price growth has actually been coming from is the market just valuing Pepsi's stock higher. Not really from the fundamental growth, but just investors are willing to pay more for this business. And this really accelerated over the past couple of years. I mean, right here in 2019, it was selling for a price to free cash flow of about 31, which is honestly quite high. And then in 2022, it got all the way up to about 40, and now it's sitting at about 35. Especially over the past couple of years, what I think has happened is investors understand and realize that, hey, we're living in these high inflationary times, and these strong brands like Pepsi are typically seen as safer stocks during high inflationary times. So I think that people have kind of flocked to Pepsi, especially over the past couple of years, as like a safe stock. However, I think that the consensus that Pepsi is a safe stock has inherently and ironically made its stock risky. The price of Pepsi today, in my opinion, has an imbalance in its risk-reward equation. Now, you may be asking yourself why, and allow me to explain. If we head back over to our freeform tool and we go and take a look at Pepsi's free cash flow yield, we can see that right now it's sitting at about 2.8-ish%. Now, what this means is that if Pepsi wanted to pay out 100% of the free cash flow that the business can generate as a dividend, then the dividend would be about 2.8%. This is the max amount that the company can deliver to shareholders and return to shareholders organically based on free cash flows. Again, that 2.8% figure. Today, the 10-year bond, which is also known as the risk-free rate, is offering about 3.9%. Now, what that means is that Pepsi's stock can return less than the 10-year bond, and quite substantially less as well. So investors think they're paying a premium for safety with Pepsi stock, when in reality, this has now become a premium for risk. For Pepsi to have a 4% free cash flow yield and ultimately yield more than a 10-year bond or the risk-free rate now, the stock would have to drop about 30% to $120 a share. And that is around the price where I would seriously take a look at Pepsi and start considering this stock. I don't know if Pepsi is going to drop down to a share price of $120. All I'm saying is that Pepsi does have to drop down to about $120 for the free cash flow yield just to be on par with the 10-year bond today. Now, you guys may be asking yourself again, where am I getting this thinking from? Like, why do I compare free cash flow yields versus the 10-year bond? And this comes directly from Benjamin Graham, who is the author of The Intelligent Investor. In The Intelligent Investor, he writes that the margin of safety comes from a business being able to return more to its shareholders than the risk-free rate. Or essentially, the business has to have a higher free cash flow yield than the risk-free rate, and the difference in free cash flow yield and the 10-year bond is the company's margin of safety. When the free cash flow yield is less than the 10-year bond, or in other words, when the 10-year bond is yielding more than the company's free cash flow, then it means that business is not selling for a margin of safety at all. That is exactly what is happening here with Pepsi stock. It has that free cash flow yield of 2.7%. The 10-year bond is sitting at 3.9%. So Pepsi's free cash flow yield is less than the risk-free rate, which means that this business is not selling for a margin of safety based on Benjamin Graham's theory of margin of safety, who, by the way, is basically the person that created the margin of safety in the first place. Like, when you're taking a look at Pepsi's business, is Pepsi going to be around over the next 20 years? I think yes. So the business doesn't have that much risk, honestly. I think it's got an incredible moat. I think it's going to be around for decades to come. In my opinion, when you're taking a look at the risk-reward scenario on this business, it's not the risk side of the equation that's out of imbalance right now. It's the reward side. When you buy Pepsi stock today, you're getting less of a reward than you would by buying a 10-year bond. So it's not selling for a margin of safety. And that's the side of the risk-reward scenario that I think is out of imbalance here. So Pepsi as a business, yeah, it's probably not very risky, but the rewards of this business, I think, don't really justify the risk to take on. That is my thinking with Pepsi stock right now. That is how I came to my conclusion. And if this stock does drop, 30%, again, I don't know if that's going to happen, but if it does drop 30%, then that is where I personally would start to get interested in it. And those are the reasons why. So if you enjoyed this video, please leave a like on it, and please let me know what your thoughts are down in the comment section below. Also, if you're interested in this platform right here that I use to do all of the stock analysis on this channel, this is Stock Unlock, and this is the platform that we are building out. And if you're interested in coming and trying it out, you can get a 14-day free trial with no credit card required just by heading over to our website and entering in your email. Then you can come and check out the entire platform. You will get access to the entire platform, and I can guarantee you this platform will make you a better investor. Seriously, go and try it out. Go and get your 14-day free trial. Play around with the platform at least on a daily basis. And again, I can guarantee you that you're going to become a better investor. It's built for fundamental investing and for people who really truly want to build their wealth over the long term in the stock market. And there's no hype, no BS. It's all just dedicated to fundamental long-term investing. So if that resonates with you, then again, go and get your 14-day free trial. But that's going to wrap up the video for today, everyone. Thank you so much for tuning in. I truly do appreciate it. And I really hope to see you all again in our next video.